The countdown to election day is on, so let's take an honest look at 3 of Donald Trump's financial policies to see whether they are dangerous or just misunderstood. If you're new here, hi, my name is Priscilla. I'm a former accountant and CPA, and on this channel I talk about all things related to money and personal finance, so let's get into it. One of Donald Trump's most well-known financial proposals is no tax on tip. He originally raised this idea at a campaign rally in June in Las Vegas. Kamala Harris later went on to support this proposal as well, which Trump famously called her out on for stealing his idea. But this aside, let's take a look into the details of this proposal. There are 3 main ideas or approaches to implementing no tax on tip. The first idea would be to reclassify tips as gifts. This could legally complicate their use in bridging the gap between tipped minimum wage, which could go as low as $2.13 an hour, and federal minimum wage, which is $7.25 an hour. This reclassification could face legal challenges because tips are essential for some employees to reach required wage levels. The second idea would be for up to $20,000 of tips to be categorized as non-taxable income. The problem with this approach is that it could inadvertently cause some workers to be disqualified from tax relief under the Earned Income Tax Credit due to a drop in their overall gross income. The third idea, which has been proposed by Senator Ted Cruz, is to create an entirely new deduction where taxpayers would consider their tips as income and then deduct them. This whole idea of no tax on tip is really exciting for those in tip-dependent industries, but there has been significant concerns as to the overall impact of this legislation. Obviously, only those in tipped industries would be affected by this. A 2023 analysis by the Yale Budget Lab revealed that only 2.5% of the workforce is in tipped occupations. Actually, this means that the majority of low and middle income earners would be unaffected. On top of that, many tipped earners, especially those who work part-time, already do not pay personal income tax if their earnings fall below the standard deduction amount. The Yale Budget Lab found that more than 1/3 of tipped workers didn't earn enough to owe federal income taxes last year, meaning that exempting them from taxes on tips wouldn't change their financial situation. Let me illustrate this with an example. Let's take a worker who earns the federal tipped minimum wage of $2.13 an hour, relying on tips to bring her wages up to that federal minimum wage of $7.25 an hour. If this worker works for 40 hours a week, 50 weeks a year, her total earnings in 1 year would be $14,500, with around $10,000 of that coming from tips. Since the standard deduction is $14,600, this worker would not be paying taxes anyway, so exempting her from taxes on tips doesn't change anything. Some economists argue that shifting the conversation to no tax on tips distracts from the real issue, which is that workers simply aren't being paid enough. There's also a separate concern that if employers know their workers won't owe taxes on tips, they may feel inclined to lower the base wages even more. Despite all of this, the National Restaurant Association supports no tax on tip legislation, as do the majority of Americans, regardless of political party affiliation. The next Trump financial proposal is to eliminate federal income taxes on Social Security benefits. Trump has expressed concerns for what he calls double taxation, which is the payroll taxes workers pay to fund the Social Security program, alongside federal taxes owed on a portion of the funds once they are received. Over 72 million Americans collect Social Security benefits each month, and approximately 60% of these recipients currently do not pay taxes on their benefits, according to the Social Security Administration. Just for full context, let me share some history on this tax. Social Security payments were not taxed until 1984, when the Reagan administration implemented rules that taxed up to 50% of the benefits if the recipient's income exceeded certain thresholds. A decade later, the Clinton administration increased the portion of benefits that could be taxed up to 85%, where the cap currently stands today. Ending taxes on Social Security could provide financial relief to those currently subject to the tax. However, it could lead to a decrease in tax revenues and put the program on an even faster track to insolvency. According to an analysis performed by Morningstar, eliminating the Social Security tax would reduce the number of U.S. workers who who are unable to fund their retirements from 45% to 41%. This is definitely some improvement, but researchers have stressed that eliminating the tax on Social Security doesn't address the underlying issues of the Social Security program. The main beneficiaries of this tax cut would likely be affluent retirees, since the tax applies to individuals over certain income thresholds. Those with substantial retirement savings, such as IRAs and pensions, would definitely benefit the most from this tax removal, but lower income retirees who exceed income thresholds would also see substantial savings as well. For those individuals in particular, even a few $1,000s in tax savings could have a substantial impact. As I briefly mentioned earlier, the core issue with eliminating taxes on Social Security benefits is that it could hasten the program's insolvency. Social Security's funds are already projected to be depleted by 2035, and eliminating taxes on benefits would just accelerate this. According to an analysis performed, the resulting $1.6 trillion loss would mean that benefits would run out a year earlier and Medicare 5 years earlier. This wouldn't completely shut the program down, but it would reduce benefit payments by around 20%. One potential solution has been proposed by U.S. Representative Angie Craig, which suggests ending taxes on benefits while increasing the cap for Social Security payroll taxes, which is currently set at around $168,000. Raising the cap to $250,000 would extend Social Security solvency by 20 years. Although this is a potential win-win situation, it's unlikely whether this bill would gain support in Congress. The bill was proposed in early 2024, but as of the recording of this video, has not yet come to a vote. Moving on, the next Trump financial proposal is to cut corporate tax rates from 21% to 15%. While there are concerns that this could increase federal budget deficits, it has also been suggested that this move may spark a stock market boom. Corporate tax cuts can increase stock prices by improving company earnings. When taxes decrease, companies pay less in taxes and can then use that money to repurchase shares or pay higher dividends. Stock buybacks reduce the total number of outstanding shares, making each remaining share more valuable, while increased dividends can attract more investors, which would drive up demand and stock prices. Historically, corporate tax cuts have had mixed impacts on stocks. While the 2018 Trump tax cuts initially saw a market decline, the S&P 500 rebounded strongly the following year. Other tax cuts, like those during the Reagan and Kennedy administrations, saw short-term gains but were impacted by other economic events. This shows that stock market performance depends on multiple factors like interest rates and economic events, not just solely tax policy. I think it's also interesting to note that even corporate tax hikes have resulted in stock gains. Since 1950, in 5 instances of tax rate increases, the S&P 500 has risen each time with an average gain of 13%. So while tax cuts may definitely help stocks, they're not the sole driver of market performance. Let me know your thoughts on Donald Trump's financial policies in the comments below, and please try and be respectful as you do that. Remember, if you want to be an informed voter, you have to understand both sides of the aisle. That's why you should watch this video right here that I did on Kamala Harris's financial proposals and what that could mean for the country.